I'm here to talk about probably one of the more important things to talk about. I think it's great that we can build great technology and innovate business models in the digital realm, but at the end of the day, I think you heard it from the very, very first panel, the importance of the exit. It's important not only because it's a net worth enhancing event, but also because it's critical as a growth vehicle for large strategic companies, as you will hear on our panel. You cannot invent everything yourself. Even Google, with 10,000 people in R&D, cannot build everything themselves. They have to acquire companies in order to gain technologies. And what I want to talk about is the unique characteristics of M&A in a digital world, and then talk about some of the buyers and what they're doing and why they're doing it. So if I told you it's better to be bought than sold, nobody in this room would disagree, right? That's an adage that everyone would say, yep, I buy into that. It's just that how you go about accomplishing that is very different from the traditional ways that companies got bought. So if you think of the world we live in today is fragmented, transparent, very dynamic, and high growth. And we've mapped these universes of all the companies in these digital channels from display to search and video and mobile, gaming, commerce, social, etc. There's over 1,500 companies just on these charts, and obviously that's just the tip of the iceberg. So we live in an extremely fragmented world. So how do you, as a corporate buyer, as a large strategic, think about how you do M&A in such a fragmented and highly changing universe? And I would argue that if you think of the world in terms of the strategic, the buyer at the top, and the target, the growth company, the digital company on the bottom, it's fairly straightforward. And folks in the room at Strategics do this all the time. They take a very proactive approach to corporate development. They think about what's going on in the industry. What does the competitive landscape look like? What do we have as a company, our unique assets? Those are all the factors that drive into what strategy to pursue. Once they figure out the strategy, they say, okay, now what capabilities would we need to affect that strategy? And then they sort of say, okay, now can we build this ourselves? Or do we need to partner and rent it? Or do we actually need to buy a company in order to gain this capability on our own? And only once they sort of come to that conclusion do they then think about, okay, now that we know what our strategy is, what capabilities we need to affect our strategy, what companies are out there that can help us best do this? So this is a very proactive, thoughtful, strategic, logical process. So if you and that's when they sort of figure out who the companies are, approach them, negotiate a deal, and very, very importantly, integrate it or not, depending on the appropriate approach. And so it's this more sort of proactive approach is the right way to do it. And yet, think about how investment bankers work, right? They tend to sign up clients, take them to market, write up a book, call 50 people, and auction the thing. And the notion was that you would maximize the value of a company by auctioning it because you'd have competition. Well, it completely falls down in a digital world. Not only is that not the way buyers buy, it actually signals adverse selection. So the company that hires a bank and runs a process is a failure, right? And the best companies are, in fact, bought. So you don't want to be sold, which is starting with the target and pitching to the buyers. You better to be bought. So I could have termed this presentation, Fire Your Investment Banker because your rockstar company is not for sale. And my advice to all the great companies out there is never, ever, ever put your company up for sale. There's a very, very different way of finding an exit. So after mapping all these 1,500 companies across these digital landscapes, we finally, in September, published the Strategic Buyer LUMAscape, which is an attempt to map the major players that are doing the acquisitions in the digital universe. And what's interesting is we mapped it 4 ways. We mapped it by type, by propensity, by capability, and by motivation. So let me walk you through it. So we mapped it by sector. So there's obviously the media companies you're familiar with. And this is relatively US-centric, although we've got some international, larger international players on here, and I'm sure we're missing some, so always welcome your input. Media, the marketing companies, the companies that are doing third-party media. The technology companies, largely software. And the network companies. Now this one, people say, wait a second, what does Samsung, Twitter, and MasterCard have in common? The reality is these are all businesses that operate large networks that transfer bits back and forth, whether those bits be content or commerce. And the reality is they actually look at digital acquisitions from a similar perspective. We also mapped it by propensity. We had the four horsemen, the original major buyers of digital media: Google, Microsoft, Yahoo, and AOL. But now we've seen increasing layers, rungs of buyers. And this is extremely healthy for the ecosystem to have a diverse group of companies that are interested in digital companies. The motivations, I mean, look, the guys on the top in technology and network are largely expanding their businesses. So when they buy digital, they're actually on the offense. Whereas, think about the traditional media and marketing companies, have largely been disintermediated by digital, and so many of the motivations they have are on the defense. So, and by the way, just one other element we didn't plan on, but it turns out, so on the left-hand side of the page is enterprise companies largely, and the right-hand side is consumer. By the way, footnote, any and all of these LUMAscapes are available on our website for high-res download if you want to take them and annotate them and do with them what you please. So if we just look at the companies within the concentric circles, just the ones that have been more active of late, it turns out that they trade at very, very different multiples. You'll note that the technology guys are trading very, very well. You'll note the key internet guys in the middle have come down quite a bit in the last year. But these trading valuations have implications on their deals. All told, in the center, $3 trillion of market cap, $450 million of cash. So it's a lot of money that they have available, but it turns out 87% of which is above the line. So, if you are building a technology company or a media company and you're interested in having someone buy, hopefully it's something that either the technology or the network companies will want to buy because they're far more capable. If you mapped the multiples along with the cash and the market cap, this is sort of what things look like. Once again, above the line, the technology and commerce and network companies being the more capable buyers. Looking at it geographically, no surprise here. Both coasts of the US and about 25% of the digital buying is happening from international concerns from the most logical locations. We analyzed over 1,000 deals in the last 5 years with over $250 billion worth of purchasing. And note that, again, the folks doing most of the buying, again, are the guys above the line, the internet guys, technology, and network companies. The valuations that they're paying, again, differ somewhat. The guys on the top are more capable of paying, and therefore they pay higher multiples. Now think about it for the guys in the bottom. If you're trading at a really low multiple and you're buying at a high multiple, it's obviously a very dilutive transaction. So it's obviously a lot harder for them. And the other thing is, when we look at all these deals, the vast majority, 3/4 of these deals, are sub $50 million. That's really small. So that has an implication in terms of how much capital to raise. You have to bear that in mind. Turns out that the sort of sizable exits over $150 million are not that frequent in digital. If you think of companies on an XY axis where X is size, small to large, and Y is strategic value, low to high, everyone would agree that being small and unstrategic, not a winner, right? Conversely, if you're very strategic and you're large, that's fantastic. You get great outcomes. That's like Buddy Media and AdMeld. But the interesting part when you think of the other two sectors. So turns out being small and strategic is good. It's okay. You're building a great technology. The buyer probably has their own customers, their own network that they can leverage your technology on, and so you can get great exit opportunities even if you're small, just enough revenue to prove the efficacy of what you're doing. The real problem comes in the bottom right here. and that is the large companies that are unstrategic. So these companies, grow, and they got great metrics, and so they continue to do fundraising, and yet there's no way anybody's ever going to buy them because what they're doing is just not unique, it's not distinctive, it's not sustainable. And these I call the growing dead. These are large companies that get a lot of attention. You read about them, some of them, and these guys are not going anywhere. And so it's obviously very important to build something that is strategic. Just by way of example, we've seen strategic acquisitions in display, in mobile, across the video landscape, and of course, very recently, a flurry of deals in the social space. So if you think about the four most sort of active universes, display, mobile, video, and social, and then map it against the buyers, it kind of looks something like that. A lot of transactions is a very dynamic, busy marketplace. And look, it's high growth, great opportunities, but in digital, there's 100 cents of downside, right? So in traditional media or technology, if you overpaid for an asset by 20%, you could do fine. Your IRR would be a little lower. In digital, there's 100 cents of downside. You can buy the wrong asset and not have it be worth anything. And listen, that comes into play. People say, does M&A work? There's been a lot of criticisms of the failure rate of M&A. And the reality is, you can make it work. Case example is Google, not because they're a sponsor of this conference, but they actually happen to do M&A, I think, pretty well. They do a lot of it. They're very thoughtful about it. And they've made some acquisitions that have really paid off well. In fact, David Lowy said that he figures 2/3 of their acquisitions have been successful. That is a really, really high win rate. And I would argue that when it matters on a dollar-weighted volume, they've probably done even better than that. So again, best to be bought, not sold. There's a process for doing that as opposed to auctioning your company. And we think that's the best way to go. Now we're going to have a discussion about strategic M&A. With that, I think.
You got a clock running. Good. Okay. Terry, clock. You have a clock.
Hi, everyone.
There's a clock.
Matt Campbell from Bloomberg again. We have Stéphanie Hospital from Orange, and of course, Terry. And on the subject of strategic M&A and getting bought, I'd like to start with what I think was the ultimate example of a remarkable, I don't know if it's a trend, but certainly something we see in the digital world occasionally, which was Instagram and Facebook. Absolutely eye-watering price, about $1 billion for a company that I believe had literally zero revenue. And an example of the business model, if you can call it that, of creating something annoying enough to one of the big players, Facebook, Google, Apple, and so on, that they buy you to get you out of the way, rather than creating a sustainable business. Is that perverse? I mean, does that create incentives that are not optimal in the tech world, or is that just a fact of life? Either of you.
So I do think it's the best things to create a company to be sold or to think about the exit. I mean, out of many companies created, there are very few that are going to be successful. Maybe one or two that are going to be extremely successful. But if the management team is only thinking about making money, I mean, it's clearly not sustainable. And maybe the Instagram team, they have done something great, a great technology, but they had a very good momentum in terms of being at the right moment for Facebook to show that they were going to do their IPO. So don't try to replicate the Instagram example, but there'll be very few winners for that game.
Yeah, I agree with Stephanie. I think first of all, you never build a company to sell it. You want to build a sustainable business. And for Instagram, look, that was a bit of a departure from normal M&A in the sense that they certainly weren't planning that. It's always better when you end up building a distinct capability that another company decides they need as opposed to they want, because need is better than want. And in Facebook's case, it's sort of, money was not the object. It was they just needed the capability, regardless, of the price. Although I will say, on that weekend, the initial ask was $2 billion. So he came down to $1 billion. Is very reasonable. Kevin, in his valuation discussions. But yeah, that was a bit of an aberration. And what I find funny is when you get situations like that, some other companies look to that and they'll in this instance, there was no multiples to pull from it. But even if there are, people will say, oh, so that means that XYZ type of companies trade at 20 times revenues. And the reality is these multiples are outputs, not inputs, and certainly not applicable to other situations.
And I want to talk a little bit about disappointment. And we've seen in the last year, certainly, some pretty high-profile stumbles from companies that were once idolized. I remember at DLD last year in Munich, everyone wanted to sort of touch Andy Mason from Groupon because he was the next big thing. I'm sure he wishes he'd sold to Google for $6 billion at this point. Zynga has gotten into some trouble. Google even had a bit of a stumble. Do acquirers and I suppose also IPO investors now have to look much, much more skeptically at these hot young companies promising that they're going to monetize?
Listen, digital is still early, right? So a lot of these companies go public and they're either yet to sort out their business model, still sorting out their business model. It's a little bit like, these are like venture IPOs in the sense that public investors have to take on the risk of having these companies that have had great traction with users, still sort of sort through how they're going to make money and be sustainable in the long run. These are not the kind of mature software businesses that we've seen go public when they're a lot further along.
Maybe this is something that is also very US-centric, because normally in Europe, when you begin a company, especially in the digital, you think more to create a long-term companies where, as a founder, you're going to stay and you're going to be paid, creating job employment, rather than thinking about being sold. And so maybe the hype, I mean, it's better to have a low profile and try to be little by little creating your company, even if in the digital space, I mean, it's clear that you need to have a lot of scale quickly and you need investment.
On the subject of low profile, that is something I'd like to ask you guys about. It seems to me that the ideas we see are getting narrower and narrower. The really big things in the digital world, at least for now, seem to have been done. You can't reinvent Facebook. Search, which is a very universal thing, is not going to be reinvented anytime soon. Do you need to be more and more a niche player to be acquired or have a successful exit?
I think you need to be distinctive. You have to be doing something that not everybody else is doing. And too many of these channels in digital, there's a lot of it's actually fragmentation is not really the problem. It's the duplication is the problem. You'll have 20 companies that are doing effectively the same thing. That is a problem. But I take issue with your premise, and that is that I think we've seen tremendous continued innovation in companies. I mean, Airbnb didn't exist 2 Monaco media forums ago. And yet, here's an innovative solution to how to monetize space, and we're seeing those kind of sort of innovative approaches to a lot of different applications still. So I don't think everything's done. We're still seeing a lot of innovation.
I mean, there's clearly a lot of innovation coming, and if we look at companies, when as Orange, we've done some acquisition recently, and we always try to think what is missing for us, what are what a company could bring us in terms of technology, in terms of management skills, and especially in the digital world where it's very complicated to create organically success. We're still trying to have our own internal development on the digital services, but often, I mean, it's when you have a company that is already launched, that has a great management team, and that has something unique for you as a big company, that it's the good moment to make the acquisition. But then it's just the beginning of the story, because making a good acquisition is you could have a good assets, you could have a good company, but if you're not tackling well the process and the way you're going to work with this company once it's integrated, then you can have a big disaster.
Now, I'd like to ask you a little bit more about that, Stéphanie. One of the things we're seeing, certainly among certain players in the telecom space, for example, companies, big companies that have certain structural challenges, are making little acquisitions to improve on the digital side, for example, as Orange has done with Dailymotion. Is that a fix? I mean, the telecom sector has big, big problems, as does the newspaper sector, as does traditional TV in some places. Are these always going to be little add-ons, or can it ever fundamentally transform the business model?
Well, I would say that M&A is at the heart of the carrier's development. I mean, remember 15 years ago, you had no mobile, you had no broadband, and the telecom industry has been built only in 15 years with incumbent player expanding, acquiring licenses, buying other company in the world. So it's clear that so far, I mean, for the telecommunication industry, it has been a play where, I mean, acquisition was the norm. Now, I mean, once you've acquired all the licenses or you developed all the countries, what's next? And I don't think we're on a trouble. I mean, if you look at the revenues and the way the telecommunication industry is making, animating all the digital ecosystem, I mean, there's still a lot to do, and we are, I mean, still very critical to make all those new services happening. I mean, it's you need networks, you need high-speed bandwidth, you need Wi-Fi connection everywhere. So the carriers are still core. But it's true that if you want to stay not only a smart pipe, you need to grasp a bit of the digital money coming out of the digital space and trying to position yourself also in this digital ecosystem to understand it, but also to acquire capabilities and technology that are not part of your DNA and that are now essential for the telecommunication world.
What do you think, Terry?
Listen, the landscape is so fragmented that any of these companies, exploring opportunities in the digital space, companies have always had the buy versus build equation. Do we do this in-house or do we have to make an acquisition? And it's more and more defaulting towards buy because of speed to market, because of the sort of acceleration of the technology curve. There's capabilities that companies just cannot invent on their own, or just cannot invent fast enough. And they want best of breed. They want a capability that's already in the marketplace, that's accepted, that's being utilized. And so M&A is becoming a more and more critical part of companies' strategic growth plans.
And you mentioned, I just have to ask you about it because it was rather amusing, the notion of firing your investment banker. Does that apply to the big strategics as well as to startups? Are they getting good advice?
Well, I think most strategics have either the business units leaders in conjunction with their strategy and development teams, really take a critical, thoughtful, strategic view towards what capabilities do we need and what companies make the most sense, and they do all the research. Look, we live in a transparent world, right? There's no new discovery of companies. I mean, the companies are out there. Heck, you can just download the LUMA, you can sort of see all the companies in those spaces. But truly, you really have to do your homework, and I think most of the companies that I interact with are pretty thoughtful about how the market's developing and what kind of companies make sense. We try and help out along that way because we have a different perspective than say just the companies in their own right. But yeah, I think they're pretty thoughtful about how they go about it.
Are bankers useful, Stéphanie?
Yes, I mean, they're useful when you know what you want to do. And for that, I mean, it's always good to not listen to the bankers unless you have, as the top management, a clear idea of what you want to do. I mean, it's good to have advice, but it's better to know which strategy you want to do and how then you're going to acquire or partners with companies to get this strategy executed.
So this is totally true of the traditional banking approach, right? Because bankers are transaction guys, right? They just want a deal, and any deal is fine, right? Because they'll get a fee on any deal. And so that was the whole premise of our model, was to say, no, we're not going to do any deal, and we're not going to sell you what we happen to have in inventory. We're going to actually help you think through. We know the space, and we'll help you think through what should you do, and therefore pursue that. Because, as I said, there's a lot of downside in picking the wrong firm.
Well, and look, on the Facebook IPO, some very well-groomed gentlemen from Morgan Stanley got it totally wrong, right? I mean, so even on the transaction side, there are these quite high-profile screw-ups.
Yeah, so this is why the best way is to have independent advisor or to have independent team, but try to have people which are neutral and not interested to make the deal for the deal. And it's often not the case of investment banking. I mean, not all. I mean, and this is how you can select them. Be sure that if finally, I mean, the company could be good, the deal could be at the right value, but if there's no sense for you to make this acquisition, then you need to have people telling you it's not worth doing it because you're going to invest a lot of money. And often, I mean, this money is just the start because it's... and maybe big corporation sometimes forgets that whenever you're acquiring a company, is to give to this company access to your scale, to your investment capability, to your distribution capability, and it's just the beginning of an investment process.
Mm. Yeah, I agree. I think you have to make sure that your advisor is knowledgeable, knows what they're talking about, and is credibly objective.
And on the subject of deals that go wrong, we have seen a few of those. HP Autonomy recently has not been so popular necessarily among HP investors, for example. Are there more cautionary tales than there used to be? Are you finding there are more deals that don't work out? Has that proportion changed over time?
Look, M&A is tough, and you know that's why you got to really pay attention. I think some have noted that there's some studies that say the majority of M&A deals have been value destructive to companies, and so. And yet there are some companies, Cisco in the 90s, Google in the last decade, that have done and I'm sure Orange, have done phenomenal jobs in their Adobe, in their M&A strategies because they've been thoughtful about what they wanted to do. They had a game plan and they executed on it.
I mean, clearly, I mean, at Orange, we had a lot of experience of M&A deals. I mean, both for the core business, but also for the new business on the business services side or on the digital space. And my personal experience after 10 years of having been close to a lot of deals, not as an M&A person, but as the operational leading that investment or being involved in that investment, is that if you want to be successful, you have to prepare in advance what and how you're going to work with the company. That means defining which projects, synergies you're going to do. Also making the rules with the company. And you're acquiring a company because you're acquiring a management team with capabilities. And often, I mean, you think that you're going to manage this activity, this company, like a business unit of your own business, and forgetting the cultural change, forgetting that you have entrepreneurs on board and that those people still want to be entrepreneurs, that is to say, deciding for the company with a lot of flexibility. So I would say that the key for successful acquisition is to make sure that the management team that you're acquiring is on board for the next 2, 3, 4 years. But for that,
and they don't just disappear.
Yes, and being clear on the entrepreneurial project you're going to offer them as a company within your group of company. So I'm personally more a strong believer of letting the company developing by themselves with a small team preparing in advance and supporting them in the way they're going to integrate in a sense of cultural integration with the company. And setting also the objective in terms of KPIs and what you want to achieve, rather than trying to integrate in the sense of taking the company and having it fully diluted within your core organization.